now get back to Yu-Dee Chang, Principal and Chief Advisor at ACE Investment Strategists in New York. Good to have you with us once again, Yu-Dee. You know, this was actually the second straight day of steep losses for the US markets. And I guess the problem here is it's not just what's going on with the banking regulation proposals, but also worries about China's curbs on bank lending, China's potential monetary policy tightening. Now, after we got the Q4 numbers yesterday for GDP, a little bit lower than expected, but nonetheless still a very strong number, above 10%. Do you think that this is a real fear and it's justified for the markets, particularly commodities, to sell off?
Yeah, that is a fear. Mandy, if you think about it, it's kind of interesting. You know, we talked about the fact that the U.S. market really hadn't had a decent correction since October of last year. If you think about it, the market went up back in March of last year. From March of last year, every other month we had a correction. So it's been a while we had a correction. And it's just that the market found its excuses. Like you were saying, China, globally, the whole world was sort of relying on China to say, with your 1.3 billion people, bring the economic recovery back. Now China is coming out and saying, well, you know what, we like to curb that a little bit. That, of course, really hurt the market a little bit. And then, of course, with Obama's proposal, also recently, all the banks are coming out with their earnings, not that great. And, of course, the housing start, if you think about it a little bit early in the week, it showed a little bit of decline, and the construction permit as well. And then, even today, as early as today, the weekly employment numbers actually came up a little bit. So with all this together, and the fact that the market was probably ripe for a correction resulting in this thing. And don't forget, since March, the market was in an uptrend. However, a 5% correction is not unusual.
Yeah, it's just interesting. I'm looking at my notes here from you, Yu-Dee, and you're saying that, you know, we've come back very sharply from the March lows early last year. We found stability, but just the last couple of months or so, the way you describe it, the market's gone through a phase of trying to find itself. I kind of like that.
Yeah, I think the market will continue to try to find itself for the balance of 2010. I think this is going to be the theme, at least from the traders that I've talked to. We all kind of believe that, you know what, this so-called trend, a slight uptrend, might still be intact. However, we are going to get abrupt directional changes as we're experiencing right now. Minimally about 3 to 5% to a maximally maybe about 8 to 10% correction. We're just seeing the beginning of this little correction here. But after this correction, when everything stabilizes, you look at S&P earnings. A little bit earlier, I was hearing the news clips about all different good earnings coming out. Guess what? I think analysts surveyed, we have about 60 out of the 500 S&P companies reporting earnings. And the analysts are saying, consensus is saying that these earnings are going to be 67% higher.
Yu-Dee, I just want to continue on the earnings strand and turn it to the big oil majors. We've got Exxon, Chevron, Conoco reporting towards the end of this month and early in February. These are huge components of the broader indices. They're also important bellwethers for the broader economy too. What do you expect them to say? Have they turned a corner, or is there still stress?
No, I think there's still a little bit of stress, especially you look at the oil prices recently, the collapse of the so-called commodity prices. Their earnings is not going to be bad. However, I think their visibility looking forward is not going to be very robust. So I think you should still expect some volatility and up and down swings in these sectors as well.
Yu-Dee, good to have you on the show once again. Yu-Dee Chang, Principal and Chief Advisor at ACE Investment Strategists.